Welcome, everybody, to episode 11 of the Reinsurance Podcast. I'm your co-host, Jared Lee.
And I'm Ben Rose.
Welcome back, sir.
Thank you very much.
The new studio, time to.
Yeah, and I'm loving how you put extra emphasis on the Reinsurance Podcast.
Yeah, it's like the Ohio State University reference. That's
a reference I'm not going to get.
A niche American audience reference that you might get. Which we are getting a lot of feedback from people like we know around the world. It's quite funny. A friend of mine in Australia, not in the industry at all, like really likes the podcast. And you were saying some friends who just like listen to it for our melodic voices, I think, because...
I think it's the nice contrast.
Yeah.
The blend of, my very refined accent.
Yeah.
No, I'm kidding.
And my raging American tone. But I thought as a shout out to both our international colleagues or international listeners, as well as our non-reinsurance listeners, what I wanted to challenge us today for sort of a 30-minute push is, can we explain like how it works? We've talked previously about sort of what it is at a very high level, but can we explain kind of the basics of how reinsurance works in the next 27 minutes? So the task we've set today.
Yeah, and I think I'm excited about this, partly because it's also going to be a part one in some ways. So hopefully diving into demystifying things like what is proportional and non-proportional and treaty and FAC and all those sorts of things. But part two, we went out for dinner yesterday, and I discovered in the process of this that our colleague Jess also has a very nerdy qualification to her name, which is the CII's very special certificate in contract wording. Which is if you do both insurance law and the contract wording CII modules, you get this special certificate in insurance contract wording. It means basically you love contract wording and insurance and reinsurance contracts and different clauses and things so much that you're willing to subject yourself to 6 hours of exams specifically on those topics.
Yeah,
which is
a painful process.
No, it's delightful. I loved it.
But if we take a step back, so we talked earlier that anything that can be insured can be then reinsured. And we've talked about the sort of the process by which an insurance company purchases their own protection, some reasons for why that is. But if we dive into sort of what that looks like in practice, how do you sort of break that out? How would you think about carving that up into products and things?
Yeah, I think there's some key splits, and it's an oversimplification in some ways, because the important thing to remember is that unlike your off-the-shelf products that you typically get, reinsurance tends to be very bespoke. So take all of these general rules we're putting out with a pinch of salt, as they say, because when we might say these types of contracts are always like this, actually oftentimes it's a bit of a blend of all sorts of elements that you can choose from. I said oftentimes. That's a really American thing to say. Anyway,
I'm rubbing off.
Spending too much time talking with you. But yeah, I think probably some of the key distinctions, as I mentioned to start with, are around what is your reinsurance covering, which I think we'll cover in the proportional, non-proportional conversation. Yep. And then beyond that as well. Sorry. What is your insurance covering, which we'll cover with the treaty, FAC, retro side of things. And then how is it triggered and how does it respond, which is then maybe more the proportional and non-proportional conversation.
But so if you start with that first piece, when insurance companies write risks, there's sort of a couple categories, right? It's generally homogenized risk. So if you're a motor insurance company or a home insurance company, you insure a huge number of individual risks, but they're all pretty similar, right? The homes in a various range of sizes, but very few insurance companies insure $45 million homes, right? It's there's a range by which they sort of participate.
Same has got to get insurance too, Jared.
Yeah, exactly. And we can talk about the per risk cover and all these things. And the same thing with cars. Like there's a huge range of cars, but on the aggregate, they're all pretty similar. So when an insurance company buys reinsurance for those, they buy them on a sort of a portfolio basis, which is a treaty, right? So it's a collection of all of those sort of relatively similar risks. But also, as we've talked about, like, what about Emirates Stadium that needs to be insured, or the Shard here in London. It's a different. It still has insurance and therefore a reinsurance, but that's a different product.
Yeah, it is. It is fascinating when you look at these very different types of portfolio and trying to customize a reinsurance package that's suitable to protect them. But let's dive in. I mean, how about we talk about then some of the ways in which we protect those portfolios. So let's say you've got this big portfolio filled with very similar cars.
Mm-hmm.
How would you typically protect that?
Yeah, there's a couple ways you could approach it, and when you look at the products themselves, there's proportional essentially and non-proportional. Proportional, as you would expect, is very much a sharing arrangement. It would have been the original sort of version of how people shared risk, but essentially, as all of the premiums come in from an insurance company, all the policyholders paying their own premiums, the insurance company pre-agrees that they will share a portion of all those premiums with their reinsurance partners, the reinsurers themselves. But then the same proportion applies to claims. So every claim that gets made after a car accident or a house fire or a theft gets equally shared to the reinsurer. So they pre-agree what that proportion is going to be, and then they share in both the premiums and the claims in that arrangement. The other way that you could do it, it's common with really homogeneous risks, would be setting what would be a non-proportional structure, but it would be where there's a limit and then an attachment that you have to sort of clear. Works very similar to personal lines insurance at that point, doesn't it?
Yeah, and I guess maybe it's good to look again at why you might buy some of these different covers. So why would you buy a proportional cover? Because I guess also it's different depending on if it's you share 50-50 versus if you share 20-80.
Yeah.
I know it's quite common, for example, in some countries where there's not much local capital available.
Mm.
The reason why insurers will buy, an 80% quota share is quite different to the reason that somebody who's in a country where there's lots of capital available might actually buy a quota share looking at things like ceding commission instead and other things. So it'd be good to get your thoughts on that.
Yeah, I think at a very sort of high level, one of the reasons you would do that is how well you understand the risk. If you know the risk really, really well and you know it's quite profitable, but you're trying to offset the exposure a little bit, you might want to retain or keep more of that risk because you know the claims are going to be relatively low, but the premium's quite good. The more you're going into a new area or a new class of business or type of business, we've talked about cyber. If there's uncertainty there, you might want to offload more of that to help you manage that. But I think you've touched on a really interesting point that I think makes sense to look into further is when you're trying to get into new geographies or access risk more efficiently. And there's using proportional insurance reinsurance is a powerful way to do that.
Yeah, absolutely. And I think this access to risk angle is really important from a reinsurer perspective as much as an insurer perspective. And it's seen, the proportional method of reinsurance is seen actually as a really critical means of accessing risk for reinsurers who want to get exposure to a risk class through an insurer, and effectively a lot of times will pay what's called a ceding commission. So basically thanks insurance company for doing all of the groundwork, marketing and selling the policies, administrating them, arranging claims payments and loss adjusting and all that sort of thing, in exchange for basically being able to follow the fortunes of that insurer. And it works nicely for the insurance company because, as you say, they might only really want to retain however much they're comfortable with, especially if it's a newer line of business, but also because they can convert some of the on-risk kind of income that they have into risk-free income if they say, right, we'll get a commission from our reinsurers instead and let the reinsurers take the hedge as to whether these policies are actually going to claim or not. So it's a really nice way for them to smooth their earnings and get some more sort of risk-free income coming in versus retaining potentially something a bit challenging to keep on the books.
Yeah, and then how would you think about the other side of that coin, which would be an insurance company choosing to take a non-proportional structure over a proportional structure? Non-proportional, again, just being they would have their own attachment point and then their own limits, so it'd be similar to a deductible of sorts, but they would have a up to $100,000 the insurance company would retain, just like our deductibles, and then the reinsurance would sit on top of that. What would be the thinking behind an insurance company taking that approach instead of proportional?
Yeah, I think typically the non-proportional products, which we typically see embodied in an excess of loss contract or similar, tend to be used for event-based exposures. So, for example, you're trying to protect against a natural catastrophe that occurs within a specific window of time, or in the case of some other products, to a specific property or a specific policy that you've got in place. And you know, as the insurer who's looking for coverage, that you have exposure there that you would rather hedge against through the payment of a reinsurance premium than keep that great big unknown on your balance sheet. So what typically happens is because you, as the insurer, are ultimately responsible for paying that claim, however big it might become, in which case, you know, in some of these cases, it's really huge, the potential exposure. You tend to buy non-proportional coverage up to the most dramatic this scenario could possibly be. And that's usually structured in what we call layers. So I'd love to maybe spend a bit of time on layers, if you can explain that in a second. But basically what you're looking to do is say, right, we love this business, it's great, you know, it's homeowners insurance, it's car insurance, or whatever it might be, on a normal year. But we know that, for example, every 1 in 10 years, something very unpredictable happens, and you end up on the hook for not just one policyholder claiming, but thousands of policyholders claiming simultaneously for exactly the same reason, which might be a hurricane or a flood or whatever it might be.
Yeah. Well, and we can dive into sort of the layering of non-proportional a little bit, but if we use the analogy of traditional insurance, when you buy insurance for your home or for your car, this sort of, even though we know the spectrum over the range of claims could be a small fire or a small flood in the home or a total loss of the property, but you generally would just buy coverage for the whole thing. But when you look at a portfolio of risk, the range is quite a bit more variant, as you suggested. So we know that on any given year we expect losses to sort of be here, and every 25 years we might have a small event which would cause this amount of losses, but in 100 years we'd expect a really, really large event. So what an insurance company will do then is buy various layers of coverage. So they'd say, well, layer 1 is what we'd expect to have every few years. We would need to have additional coverage from here on out. But what they don't want to do is then set, because as you said, the losses can be enormous. But buying every single year coverage in a single layer that's just goes up to hundreds and hundreds of millions of pounds of coverage doesn't make sense. So what they then instead decide to do is break that coverage into different layers and then be able to purchase those different levels of coverage at their own price points. So the first level, which is usually like the lowest layer, the working layer, is a bit more expensive in relation to the amount of coverage, because it's very likely the reinsurer will pay some claims into that first layer. But as you go up, the proportion of premium that you pay in relation to the coverage goes down. So if you think about the very top layer, it would have had to have incurred a bunch of claims all the way up the tower before that gets touched. So different reinsurers will charge less money at that level because the amount of losses would have to be quite high to get to there in the first place. And it also sort of lends itself to different reinsurers who have different appetites for risk. So reinsurers who like to write on the lower layers take more premium for that risk, but they also are more exposed to potential claims down there. And the higher you go, they get a bit less premium for the exposure that they have, but it's also less likely that they'll pay the claim. So it's a really easy mechanism to align risk appetite with income appetite that those reinsurers would have. So it's all about matching these things up.
Absolutely. And I guess I can try and illustrate with a bit of an example that touches on how these things are priced. Again, this is very high level for our more professional reinsurance audience, but when you're thinking about this type of non-proportional coverage, These layers are created, as Jared said, to help align appetite to different types of coverage, but to avoid a scenario where you're basically asking the underwriters to say, how likely is it that this coverage gets used anywhere between, we'd like a little bit of support to we'd like you to pay for literally Armageddon, happening. And so what they do is they say, right, layer 1 is just above your retention, so the amount that you're willing to keep as the insurance company and to pay yourself. So just above that, we're going to offer you, some coverage to pay out. And the likelihood of you having losses which go above your retention slightly is actually really high. Maybe that first attritional layer, the working layer, is going to get triggered every 1 in 2 years. A really simplified pricing model that would account for the fact that this layer is going to get hit once in every 2 years, ignoring coverage for expenses and commissions and all that sort of thing. Would be 1 in 2 years, so we're going to charge what's known as a 50% rate online, and say that's the price. You're going to have to pay us basically the equivalent of half the potential claim that this layer covers in exchange for not having to pay that all in one go and paying 100% of the claim by yourself. And so it's a sort of regular hedge. The next layer up, maybe that only happens, maybe it's only predicted to be hit once in every 5 years, in which case the rate online ends up being, again, excluding all the expenses and all that sort of thing, 20% rate online. So you agree to pay every year 20% of the cost that you'd have to pay out in the event of a loss, rather than potentially having to pay 100% all in 1 year. And this carries on working right the way up to the top of the tower. So you have some layers at the very top where it's like, this is a 1 in 200 event that we don't think is ever going to happen ideally, or at least not while we're alive, but it could. And if we don't buy reinsurance all the way up to there, we're on the hook to pay that claim if it happens. And so you end up with, a 0.5% on rate online. So it's relatively cheap, but it's actually still expensive because it's on such a large potential payout. So you see, as Jared mentioned, quite a range of appetites. Some reinsurers who specialize in providing coverage for 1 in 200 events, and others who would much rather play in that sort of 1 in 2. Yeah.
Well, and we talked earlier in earlier episodes about one of the reasons for this is to level the earnings of an insurance company. And this, you've hit the nail on the head there, where if we pay this much in reinsurance premium every single year as an insurance company, we know that will offset any big claim. But if you didn't buy reinsurance, the insurance company might have no claims 2 years in a row, and then the third year have their income or their balance sheet really badly hurt by huge losses. And purchasing reinsurance, especially in this sort of structure, allows them to balance out those future losses, those potential losses, on a yearly basis, knowing they're thinking about it in a multi-year kind of view. So it sort of aligns with how the underlying justification, or one of the underlying justifications for purchasing the cover.
Absolutely. So that's the different, I guess, ways of structuring, proportional versus non-proportional, layers versus, follow the fortunes and share premiums and claims equally. In terms of what's covered, we have a few different types that we mentioned earlier on. So maybe you can help our listeners think about the difference between FAC and treaty and retro. Like what do those strange words mean?
Yeah, so treaty we touched on a bit earlier, which is that sort of portfolio of relatively similar risks that they can sort of group together, and they buy the protection, the reinsurance on the underlying activity of that whole portfolio. So all the premiums that will go into that portfolio, all the claims that will be incurred from that portfolio. Facultative would be when you have very large one-off risks. So again, if I'm writing property insurance, I might write a number of homes upwards of up to $1 million in value. But I also write the Shard, which is a multi-$100 million, billion-dollar skyscraper. Like, I don't want to include that in my homeowner's portfolio because it might skew the results of that portfolio. So what you do instead is you purchase reinsurance for just that specific risk. So and that can be a couple risks that are very similar but stand out quite drastically, or it's individual risks in their entirety. But it's intended, the same mechanism is at play. You could do it proportionally, or you could do it on a non-proportional basis, but you're essentially saying this one risk is individual and unique and it requires its own underwriting, but you're seeking to protect that singular asset versus a portfolio. Retro, we've talked about a bit before, but it's when the reinsurance company purchases their reinsurance. So that's usually, again, a portfolio because they've written reinsurance across a number of different insurance company clients that they're then saying, okay, well, we don't want, as you said, it's a hedging mechanism. They don't want the potential exposure for all those insurance companies to land in any given year. So they too will say, okay, we want to offload some of this risk into other reinsurers who will, help offset any exposure that they have.
Yeah, and I hope we're gradually contributing. I know people are listening without much visual aid here, but I hope we're helping to contribute towards a vague visual tree diagram, or similar that you're building in your head. So it can be proportional or non-proportional, but then it can also, on a different dimension, be FAC or treaty or retro. It does get a little bit confusing as well because I think with the FAC treaty retro angle, it's easy to think single risk versus portfolio of risk versus portfolio of portfolios of risk. That's a really useful starting framework. But actually, there are some extra mechanisms within treaty, for example, that let you cover for large single risks in your portfolio. So whereas we talked a bit about what I call, I think, event-based insurance. So this would tend to be catastrophe insurance or similar. Those are probably the most common treaties, but it's also quite usual to see a dual purchase made to cover a portfolio. One to cover the portfolio as a whole. So if the portfolio's losses exceed a certain threshold, the policy is triggered. You also get another type of policy, another type of treaty coverage, which is bought to cover any one risk within that portfolio without specifying which risk.
Yeah.
So this is the difference here between FAC and treaty per risk. So if any one risk that falls into a particular category happens to have a unusually large loss based on what the portfolio is predicted to do, then you can also get coverage for that risk. So let's say you're insuring, thousands of homes in a given region, and a small subset of your portfolio of homes are £45 million each, whatever it might be, or a few million, the luxury mansions in your estate. And if one of those has a fire, or has an unusually large loss by itself, but there was no hurricane and there was no catastrophe event, so the overall threshold wasn't triggered, then you're going to be quite annoyed as an insurance company because you ideally want to be paying lots of the normal claims where like a normal person's house catches fire and it's like, yep, that's fine, we'll reimburse your house. You don't want to be paying for these mansions that are, getting much more expensive claims attached to them. Ideally, you'd like reinsurance support on those too.
Yeah, and when I was first getting into the industry, we were working with, in the U.S., Chubb on some stuff, and they had this private client sort of solutions where they had a bunch of traditional homes and very classic business, but they built this whole product class out specifically designed at the ultra high net worth audience who would have yachts and mansions and these kinds of things. And they wanted to support those individual homeowners. But you're exactly right. If a $50 million home has a fire, is destroyed in a landslide in California or something, like that hurts a lot for an insurance company, way more than hundreds of couple $100,000 homes, right? So it's another mechanism. And you can begin to see, if you're thinking through this process, you can begin to see the sort of natural evolution of the industry, right? Originally it was simple risks and it was just, let's share the fortunes as we sort of protect ourselves. And then as you started growing and it was a number of similar size homes, it's okay, we can begin to group these together. And then as bigger single risks began to emerge, there was this, okay, well, we can't bundle that into a portfolio, so maybe so FAC branches out, or we want to include this with our homeowners purchase, but we don't want that one big exposure to sort of blow out the program. So you begin to sort of see how this might bit by bit develop naturally. And this is an industry that's always evolved in that same way. There's always people trying to go, okay, that's a specific and unique challenge that a client is facing. How might we go into the reinsurance sphere and protect against that? And the reinsurance sphere being very willing to do everything bespoke, look at every single challenge the client faces and understanding what they're trying to accomplish, and creating solutions from scratch. Over time, those solutions become more sort of common and something that the industry becomes very familiar with. But it all starts with finding underlying needs that need protection, insuring, and then building a support mechanism for that in the reinsurance sector. So it's a really fascinating one. You can begin to see bit by bit how it would have naturally evolved to where we are today.
Fabulous. And for those of you who are now completely overloaded with information about reinsurance contracts, we like to end our more technical episodes with something a bit lighthearted. So that means, folks, it's time to play Frisk Risk.
Okay.
And
I think I did pretty good last time.
You did
so
very,
I'm ready.
very well last time. You did. So as a reminder for those of you who haven't heard us play Frisk Risk before, the rules are simple. I, at least it seems to be me so far, present Jared with a difficult task, working out which of the made-up risks or real risks that I present to him are, in fact, real insurance policies, and those which are something that I've just made up off the top of my head. So, as usual, I'm bringing with me 2 risks for you today, Jared, and you must establish which one is a real risk and which one is not.
I'm ready.
You ready?
Yeah.
Okay. I'm trying to put my poker face on and look you in the eye while I tell you these. So the first one, I don't think it actually needs much explaining. Alien abduction insurance. Does what it says on the tin. Everyone wants it, surely. Is it a real thing? And then the second one, ghost insurance and haunting insurance and being exposed to those kind of ghosts and werewolves things.
This one is...
Over to you, sir. Frisk those risks.
This one is a bit tricky because I know there was a policy in the U.S. a number of years ago that was, I think there was something around this where it was like rapture coverage. So you could buy like pet insurance if you disappeared in the rapture or something. So I know there's these things can exist, right? It's very strange. I think you can buy insurance for hauntings, but I don't think you can buy insurance for alien abductions.
Dun, 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 dun. That was my attempt at this kind of tense drum roll rather than any kind of haunting music for anyone who's confused.
Is that right?
Sort of, but I did a trick question. So they are actually both insurable risks. And I'm reliably, I put that in quotation marks, by the internet, I am reliably insured that more than 30,000 alien abduction insurance policies were sold out of Lloyd's of London long ago or recently. Who knows? Maybe they still carry on. I think there was an MGA or something that
Pure
used
profit.
to specialize. Yeah, exactly.
What's the rate online?
Who knows, right? Who knows? But yes, so that was actually a real thing.
Yeah.
And so was the ghost one. So I give you
Really?
2 real risks. So you were right to be challenging the other one. Yeah, there's a hotel in, I think, Lowestoft or somewhere in the UK actually that was so haunted by sort of national rankings for how haunted a place could be that they actually arranged to take out special coverage for all of their staff and guests against particularly bad poltergeists or hauntings or otherwise.
I'd be interested to see what they could claim against. Like would it be coverage if a guest decided to not they get the hotel for a week and they leave after the first night because they're haunted? Could insurance like cover the aggregate losses of people being refunded for the remainder of their trips that they forego? Or
maybe
it wouldn't be personal injury, surely. Like a poltergeist hits you with a lamp.
So I think it included all manner of things like, werewolves and zombies and any kind of strange ghostly happenings. So
yeah,
I guess it could have just been an all risks policy that was a bit more explicit about what it was covering. If anything happens to our staff, or I guess even if it's something that we've never seen any actual evidence of existing on planet Earth, then they will be covered. Which is a good stance.
I'd be also interested to see how many of these policies have ever paid out. Like, I was abducted. Like, you have to provide evidence of this.
And now, with that in mind, it is time for us to be abducted as well.
Ooh.
And to bring this happy 11th episode of.
I'm hoping Cordy plays dramatic, like alien abduction
Ooh,
sound.
can we do
music.
a twist? Yeah.
Yeah.
Cordy, if you've got a synthesizer, if you try and find like a retro organ sound and a modulator, and just like wiggle the modulator so it goes like ooh, then that's what we need. I think.
And if video, we can like fade it out like we've been.
Yeah.
Yeah.
Turned out.
So with that, we will hopefully see you next time.
I said we should have saved that one for Halloween, shouldn't we? I feel like we've done.
They'll forget by then. It'll be
We could do another monster-related
exactly
podcast episode in October. Yeah.
Perfect.
Anyway.
Well, with that, we'll bid everyone an adieu.
Yeah, watch out for ghosts and aliens.
Yeah, stay safe out there.